Hi, I'm Jonathan Wernick. I'm a global equity analyst for Sasfin Wealth, and with me is Craig Pheiffer, Chief Investment Strategist at Sasfin Wealth.
Hi Jonathan, great to be here and great to be talking about the Sasfin Global Equity portfolio.
Thanks, Craig. So today we're going to be talking about global equity markets as well as the performance of the global equity model. Hopefully this will provide some insight for you. Craig, it's been a difficult quarter. It's another down quarter. It's actually the third consecutive down quarter for global equity markets. So maybe you can just tell us some of the headwinds that have faced global equity markets, not just for the quarter, but maybe for the entire year so far.
Yes, thanks Jonathan. It's been a protracted story and nobody likes to see all the red on their screens and on their statements every month and every quarter. But what we've been experiencing is a macro environment of high interest rates, and more recently and probably more aligned to this last quarter was a more aggressive stance from the central banks around the world to increase interest rates. And they're increasing interest rates to combat high inflation. It's decade-long, multi-decade-long or high inflation. And that's forced those central banks to push up rates very aggressively. We had, in the earlier part of the year, a view that we would get to a peak level of inflation along with a peak level of interest rates, probably later in this year, and start anticipating that interest rates would actually start falling, particularly in the US next year. We got to in the mid-quarter, sort of towards the end of August, when we had the Jackson Hole Symposium, where Jerome Powell, the head of the governor of the Federal Reserve, really started taking a hard line on inflation and interest rates, along with central bankers around the world. And they said at that point, we're going to continue to put up interest rates until we've beaten this inflation thing. And at this point in time, at the end of the quarter, we still haven't got a view of when that peak in inflation is going to be. And the Federal Reserve has already raised rates the last 3 times by 75 basis points. So they've been very aggressive in tightening rates. And the thing for equity markets is they don't like high interest rates. It makes the cost of capital more expensive. And when you're using higher rates, higher yields, when you discount cash flows for long periods of time, when you discount that back to today, it means lower values or lower prices. So we're really trying to anticipate when the Fed will, or anybody will tell us that inflation has peaked, we're moving lower, and interest rates don't have to keep going up and up and up. So I think that's where we are at this point in time. That's where we were over the last quarter, and markets still very edgy and uncertain while we don't know where inflation and interest rates are going.
Sure. And besides the central banks hiking rates, we've also had some other incidents around the globe. I think in the UK, the new Prime Minister came in, and there was a bit of, let's just say they're going through a bit of a tough time at the moment. Maybe you can just briefly touch on what's happening in the UK and with their rates. Yes, well,
they've also facing, their inflation was looking to go into their consumer price inflation. They anticipated, they were talking about 13%, maybe it doesn't get that high, but they were looking at very high levels of inflation, and the Bank of England also pushing up interest rates aggressively to combat that, like central banks around the world. But a big part of the inflation push around the world has come from higher energy prices. And households across the world, but the government of the day, or the new government of the day in the UK, have decided that they want to provide some relief to those households and cap their energy expenditure. So what they've been doing is a fiscal package, tax cuts, and capping households' energy expenses. So that's taken a big whack out of the fiscus. They've got to spend more money that they don't actually have. It's unfunded. So to do that, they would need to sell more bonds in the market at a time when the market is tightening up. We're experiencing quantitative tightening as opposed to the quantitative easing before, where central banks were selling bonds. Now they're buying bonds back. And now you've got the UK or the Bank of England looking to, in this whole environment of quantitative tightening, to actually, start manipulating the interest rate markets to try and get some liquidity in there, and actually to sell bonds to fund these tax cuts. So it's created a huge amount of mixed signals for the market. Certainly in the UK, and even now they're looking to even think about reversing those. It's just created pandemonium, uncertainty, and it hasn't really had the desired effect to calm that market. So we'll wait and see how that plays out, but it's just added to the uncertainty of markets. And as you said, in this environment, uncertainty, what do people do? They just go back to what they know, what they have faith and trust in, and around the globe, that's been into the US dollar. And that's also hurt a lot of these, what we see companies in the equity portfolio that do business around the rest of the world. And those sales and those revenues, when they're translated via a stronger dollar, translate into lower revenues and lower earnings. So a risk-off environment's created a stronger dollar, which has hurt other currencies around the world as well. And it's had a huge knock-on effect on corporate earnings as well. So we've really had it from all sides, as you can tell.
Definitely, and maybe just to close off that point, maybe you can just touch on China's also going through their own challenges at the moment. Maybe just touch on a few points there and what they're busy facing.
Yeah, so China's got, they've got a couple of problems, and more recently, earlier, even during the course of last year, it has been about the regulatory tightening of some of their companies, drawing them into the fold, and just restricting what they do. The gaming companies, checking the content and making sure it's all above board for publication, and that's halted the issue of games. But I think that tightening of the regulatory environment and just looking at the online retailers, how they behave, looking at antitrust, just making sure these companies don't get too big. I think we had that whole regulatory tightening, but we've also had more recently this zero COVID policy, and that's initiated the government to lock down cities and lock down ports and just reduce economic activity in those zones. And I'll mention the ports in particular because China does a lot of trade with the rest of the world, ourselves included. And closing those ports has also meant, less goods going to where they should go, and just exacerbating the supply shortages that we know have been around, since the pandemic times. So the China story and the lockdown of cities has had that impact on slowing economic activity and slowing down global trade and impacting supply shortages. And I think their zero COVID policy also just reducing economic activity, their own demand. If people can't move about and produce goods and services and demand goods and services, that slowed the Chinese economy as well. And the Chinese economy, they demand goods and services from the rest of the world.
Sure, and maybe the property sector as well. That's, the stories you read in the news, home buyers there are stopping payments on their mortgages, and these property developers are almost underwater. Some of them have defaulted, and that's just created a further panic and pandemonium in that market.
That's it exactly, and I think in that environment you've got the People's Bank of China actually trying to stimulate demand then to combat some of these issues, and actually cutting interest rates when the rest of the world are increasing interest rates. So that also impacts currency levels and tensions, increases the geopolitical tension between trading partners. You've got things like the yen going to lows that we haven't seen for decades as well. The Bank of Japan stepping in to intervene in their currency for the first time since the 80s. So it's certainly interesting times, peculiar times, and interesting to be managing funds in this kind of tough market.
Interesting is an interesting word. I think this is maybe a good segue where we can move on from the performance of global equity markets, maybe to the performance of the global equity model. It was a down month or down quarter for the model. It was not as bad as the MSCI Equity, which is basically the benchmark for the model, but still a down quarter. And for the most part, most of the stocks that we hold were down. If we start analyzing and we go maybe from a sectoral basis, there were a couple of sectors that underperformed quite a bit. The financial sector and information technology were probably the two biggest standouts there. If we start off with the financials, and maybe this ties back to your discussion on China, maybe one of the biggest underperformers was AIA. Maybe you can just touch on AIA a bit, as well as why we still hold it and like the company.
Yeah, sure. So AIA is it covers the Asian region, so ex-Japan, excluding Japan, but they operate in about 18 territories there, and they're pretty much the world's biggest life insurer by market cap. So life insurance is their game, health insurance is their game, and as a life and a health insurer, they also have a surplus. They also have funds that they hold and manage to take care of their liabilities. So the double whammy they got was firstly with markets falling as they did, and Chinese markets on the back of those property concerns, the lockdowns, all of those lower demand, lower economic activity, the Chinese markets really also got quite badly hurt. So the value of those funds that the life insurer owns fell quite substantially. So as we know from accounting, the value of your funds, if it falls, you have to write that down sort of through the income statement. So that was a bit of a knock. But I think just the slowdown and the whole COVID experience, on top of the weaker markets, hurt the company. But one must, and I think this is a short-term thing, they were really growing well before the pandemic. And if one looks at the changing demographics around the region, there is an aging population, there is a growing middle class, so there's more and more people, more and more of that aging population that can afford life insurance, health insurance, and so the market is certainly growing for them. A bigger pool for them to sell their life and health products to. And perversely, COVID also maybe raised awareness about having life insurance and having medical insurance. So they're also in partnership with the likes of our own Discovery in their vitality programs. They've got Amplify Health as well. So they're trying to do those same kind of things. So that's where that company operates. And so maybe short term, there's still going to be a few tricky paths to negotiate. But I think looking at the demographics, the changing environment that they operate in, and the fact that they're skilled at doing what they do, I do see upside there over the longer term. So it's certainly one we're going to be keeping in the portfolio.
Great. So I mentioned the other sector where they were detracted from the performance was information technology. And if you dig a bit deeper into that sector, you'll see that it was the semiconductor stocks that were quite weak during the quarter. And we hold a couple of semiconductor companies, NVIDIA being one, Samsung and ASML. And NVIDIA was the largest underperformer of that cohort. And it was a tough quarter for NVIDIA. There were a lot of headwinds that it faced and that came through. The semiconductor industry is a cyclical industry, and it goes through peaks and troughs. And right now, we have seen quite a slowdown on the PC side, PC equipment, and that obviously flows through into semiconductor companies. So NVIDIA had to deal with a slowdown in the PC market, and also gaming's been a bit weak, so that meant demand for NVIDIA's GPUs have been weak. So maybe just taking a step back, a lot of people might not know NVIDIA, but NVIDIA is mostly known as a gaming company. They produce what they call graphic processing units, which are used in gaming PCs, and essentially they're used to deliver high-end graphics for the gamers. The slowdown in PC sales and gaming, as I mentioned, that's been a headwind for NVIDIA, but then another thing that NVIDIA's GPUs have been used for is cryptocurrency mining. And we've seen the price of many crypto assets fall quite steeply over the year. But we've also seen a shift in the calculation of how one of the cryptocurrencies, Ethereum, is essentially mined. And that change in the calculations also reduced demand for NVIDIA's GPUs. Another difficulty NVIDIA faced when looking at its quarterly report was it had to take a big write-down in inventory. because of the demand falling, the average selling price for GPUs has gone down, and they had to take a write-off in their inventory, which hit the income statement. So there were quite a few factors in the numbers it reported that were a big headwind for it. And then another thing that's come out recently is legislation from the US, which is basically stopping the sale of NVIDIA's high-end GPUs into China. Specifically, those GPUs are not used for gaming. It's more on the artificial intelligence side. And there's concern that the Chinese might be using it for purposes of weapons and who knows what else. But the US was quite concerned about that, and they've basically introduced new legislation which essentially prohibits NVIDIA from selling those highest of the high-end GPUs into China. So taking all those things into consideration, it was a difficult quarter for NVIDIA. It's not the first bad quarter NVIDIA's had in its near 3-decade history. Probably won't be the last. But you know, we're not Vin Diesel. We don't live our lives a quarter mile at a time. You know, we're more interested in the long-term aspect, and I'll touch on that in a bit in terms of semiconductors while we're still positive. But just before I go there, the other two semiconductor stocks that we hold, the one is Samsung. Again, a difficult quarter for Samsung in the sense that you can see weakening demand as well as pricing for its products in the semiconductor space. A lot of people are familiar with Samsung in terms of mobile phones or smartphones and television sets, but Samsung is classified as a semiconductor company because it is the largest manufacturer of semiconductor chips in the memory space. But it's also involved in contract manufacturing, so companies that design semiconductors might not necessarily make them themselves, they outsource it. And Samsung is one of those companies that go to manufacture the chips on the other company's behalf. And obviously the semiconductor cycle being in a bit of a downturn, that hurts Samsung's share price during the quarter. And then the last company that we hold, ASML, they don't make semiconductors, but they make the machinery or the equipment that is used to make semiconductors. And even it couldn't escape the negative sentiment that's surrounding semiconductors at the moment. So it also fell during the quarter. Now, it probably sounds like all doom and gloom. Semiconductors is, you know, a place you wouldn't want to be. But I think the long-term prospects for semiconductors are quite bright. If you look at the industry outlook, the industry is expected to grow to about $1 trillion by the end of the decade. That means it's probably going to almost double in size from where it is now. If you look at that on an annual growth rate, that's quite an attractive growth rate in and of itself compared to maybe the overall GDP for countries. That demand is just going to come from the need for semiconductors. They are ubiquitous. They're everywhere around us. Your PC, your smartphone, your car, your TV, name a device, there's probably a semiconductor or a semiconductor chip in that device. So the prospects for the industry as a whole are still very attractive. If I tie that back to our holdings, starting with NVIDIA, so yes, difficult quarter for NVIDIA, might have another difficult quarter again, but longer term, NVIDIA is probably one of the most exciting spaces in the world at the moment, which is artificial intelligence, AI. And NVIDIA's GPUs are essentially the market leader when it comes to AI. They are the best at performing the calculations for AI, specifically machine learning. So you'll find these hyperscalers or cloud computing companies like Amazon, Alphabet, Microsoft, they have these massive warehouses where they put these GPUs and they're used to perform calculations. And that demand, I think, is still going to be quite strong going forward. You know, if you think about the use cases for AI, be it recommendation engines, natural language processing, conversational AI, when you speak into your Siri or your Alexa, whichever device you use, that's going into a GPU and being interpreted to come back to you with some kind of accurate response. And the GPUs are used to train machines to understand what we're saying. So I mean, we could spend another hour here just talking about AI and how exciting it is. But certainly for NVIDIA, I think the longer term prospects still look quite exciting. You just have to look out into the future rather than focusing on the short term. On ASML, we're talking about semiconductors, but without ASML, none of this would be possible. They're the only company in the world that can make the machinery that is capable of making these high-end, high-performing, tiny semiconductors. They're the only ones with the technology that can make these semiconductors, or the machines that can make semiconductors at scale. If you think about it, if they're the only ones, in the game, they've got quite a serious competitive advantage. And with the industry set to grow at the rate that's expected, they're also in a very good place going forward. So again, still quite positive on ASML. I'll touch on Samsung in a bit, but there were one or two companies that actually did have a positive quarter, believe it or not. It wasn't all down. The first one was Amazon, and another one was Home Depot. On Amazon, maybe you can just touch on it a bit, but I think there was a lot of negativity going into its quarterly results that things were going to be terrible, inflation's really high, and I think they surprised the market a bit, and the share price got a bit of a bump from that. But maybe you just want to just touch on Amazon.
I think Amazon, along with the likes of Apple, when we had the Q2 earnings season, the market was expecting, okay-ish kind of results, but a pretty poor outlook. And when those companies reported, specifically, the Amazon results, there was an operating loss at the bottom line, and maybe also part of that was, accounting measures where you have to, write down or impair things on your balance sheet, or some of your assets. But they reported a loss all around, so it wasn't great. But the outlook wasn't bleak. It wasn't what the market was expecting, and that there is a future for Amazon. I think part of the weaker outlook was also during COVID. They really expanded the business to really build warehouses, cater for this big surge in online retail when everybody was stuck at home, and now that everybody's back in the shops, maybe they don't need all that space. But they've even announced another Prime Day, unprecedented to have 2 Prime Days in 1 year. Fill those warehouses, get things going again. So I think again, like with the semiconductor space, it's a short-term negative story, but the longer-term picture is still very positive. And that's, as investors of other people's money, that's the kind of thing that we're looking for, the longer-term picture and growing that capital over time. And there are going to be bumps in the road and cycles, as you said, with semiconductors, but it's about looking to the longer term. And I think we got a bit more of a brighter outlook than the market was expecting, particularly with those 2 stocks. So we got a good quarter from them. Home Depot as well. In this environment where maybe there is a bit of a historical elements to it, but with people at homes, with disposable incomes now coming under pressure with high inflation, people would rather jazz up their homes, jazz up their bathrooms rather than move house. And there was a good demand for Home Depot's products, and record revenues, record earnings, even in these very tough times. So it does highlight that even in difficult times, there are parts of the market, parts of the economy that can still do well. And that's been a pretty good story, and also well managed, and a positive outlook for that company and their earnings still going forward.
No, certainly, Craig. I think maybe now's also a good time to just talk about the changes that we actually made to our holdings in the portfolio. I'll start with the addition we made, which was Thermo Fisher. Maybe you can just take us through our thinking about the company and what we actually like about Thermo Fisher.
Well, I think it starts at a bit of a sectoral level as well. So we don't just look at the portfolio and try and find individual stocks that make up our best 25 stocks that we think are going to do well. But we do look at those sectors, and I'll stop short of saying thematic, but sectors that we like, for the different environment. And given the environment that we're in, looking at healthcare as a more defensive environment is where we have placed a lot of store. And within healthcare, pharmacare particularly is makes up, say, half that market, but it provides a basic defense in these tough times. So we own the Roches, we own the Johnson & Johnson, we own the United Health in that kind of pharma healthcare space. But we were looking broader in that healthcare sector, and in that part of the market there's also a group of companies around medical technology. The guys that at the very bottom end, let's just say, provide syringes, but they provide the lab equipment. They provide all the equipment in the life sciences space that actually help those medical companies develop COVID vaccines, the test tubes, the labs, the picks and shovels. That's it exactly. But all the very sophisticated picks and shovels. So I think that's the bulk of that life sciences business. Developing new drugs. We're going to have a renewed focus on developing vaccines and staying on top of the next COVID outbreak. So you're going to need a company that provides that infrastructure and all of those bells and whistles and tools to do that. So we looked at there's a couple of companies in that space, even the likes of Danaher, but then again you kind of refine your look at the company management, outlook on earnings, return on invested capital, and Thermo Fisher just ticked a lot of those boxes, and looks like a very good story for the longer term again, and it fits the portfolio quite well.
No, I definitely agree with that. So we added Thermo Fisher during the quarter, but the company we did sell during the quarter was Samsung. I did mention I'd touch on it again. Yes. So while we are positive about the semiconductor space, Samsung was a bit of a different story. And I think a lot of it has to do with Samsung's ambitions. So as I mentioned, Samsung does manufacture semiconductors, but they're not the number one player. They're effectively the number two player, or the number two foundry in the world, behind Taiwan Semiconductor Manufacturing Company, or TSMC. They are the leading fabricator in the world. And Samsung has ambitions to become number one. And to do that, they're going to be spending a hell of a lot of money to actually achieve that goal. We're talking billions upon billions to build these very expensive factories or fabrication plants that are used to manufacture semiconductors. Now, building a fab, which is short for fabrication plant, doesn't just make you better. You can build as many as you want, but there's a lot of skill and technical knowledge that goes into it. And TSMC, over time, really built up that knowledge to such an extent that they surpassed the previous leader, which was Intel. And now TSMC is the leader in that space. And Samsung has goals to surpass, or at least catch, TSMC to make leading edge chips, basically the smallest high performance chips in the world. And they're going to be spending billions that we spoke about, and they're going to need a lot of skills, and it's going to take time to do it. And all those factors, I think, has just created a bit of uncertainty for us, given the environment we may be going into, which could be quite challenging if we're dealing with higher inflation. And if you look at Samsung's performance in terms of the returns it generates on the capital it invests, it's been it's been adequate. It hasn't been bad. It hasn't been spectacular, but it's been adequate. But there are periods where it does dip even below its cost of capital. And in an environment which might be more challenging, we'd prefer to own companies where there's more stability in those returns on capital, and probably a higher level of returns on capital, so they can absorb any potential shocks that may occur, over the longer term. And I think it's those reasons that basically pushed us to exit our position in Samsung. So Craig, we've spoken about what's happened in the markets and in the portfolio, but maybe let's turn our attention to the future and what our outlook is and the way forward for us. You touched on it briefly, but maybe just you can reiterate the point about the uncertainty that's still floating around in the markets with interest rates.
Yes, so our best defense in times like this, when the market is, volatile, there's a lot of uncertainty about, and that uncertainty really is about, when do interest rates peak? When is this bear market going to end, and when will things start getting better? We don't know. So there could be more weakness to come. But our best defense is to, when we look at the portfolio, when we look at the sectors that we want to be in, we've taken our view on that, and we've found the companies that we think will do best in that. It's in picking those companies that we do our best work, our best, and are our best defense. Buying quality companies and buying them, at a reasonable price or a fair price, not overpaying for them. And sometimes you have to sit it out for some time until, that value is realized or the company really hits its straps and gets going. But we're dealing with large mega cap, multi-billion-dollar companies with massive revenues. These aren't fly-by-night companies. Even the best of companies has a bad patch, and sometimes, they go awry, and that's why you have to keep watching them. But again, just looking at those individual companies, making sure they tick the box of quality and are going to be around for the long term, maybe have a good competitive moat, something that differentiates them from somebody else, and just from the ground up then build your portfolio with those companies that are going to endure this cycle. And we are there for the longer term. We want to grow capital over the longer term. The only way to do that is to be in the equity market. It's the volatility that's scary, and particularly this year we've seen, but it's a volatility that helps you. If you don't have share prices moving up and down, they're not going to move up over the longer term. So you have to be in equity, grow your portfolio, and the equities that you be in, you need to do your homework, and that's what we do day in and day out, is doing the homework to find those companies that will stand the test of time and grow our clients' funds over the longer term.
I think maybe just to add on to that, assuming we go into a different environment from what we've seen maybe over the past decade or so, where it's been fairly benign inflation, call it the macroeconomic variables have been fairly stable, to where we might be heading in an environment where we start to see a lot more volatility, be it interest rates, inflation, GDP figures. What's going to be very challenging in those environments for companies is actually deploying capital and invest in it. And to that point, you probably want a really strong management team as well. So on top of just looking for businesses that have high returns on capital, that are trading at reasonable prices, have competitive advantages, have good growth prospects, whatever they may be, you want a management team that you have confidence in, that can actually deploy the capital for those companies, essentially reinvesting your own capital on your behalf. You need strong management teams in environments that are going to be challenging. So that's also something we spend a lot of time looking at these management teams. We've spoken about, we look at quality businesses. Share prices for quality have essentially fallen more than maybe some of its value counterparts, if you want to put that label on it.
They've lagged a bit.
Which has been disappointing. There's no other way to say it. But at the same time, that also brings opportunity, because we follow a lot of companies that are high quality that were just too expensive or trading at too high a premium for us, that just made them unattractive investment opportunities. But some of them have fallen to price levels that are starting to look quite reasonable. And I think we're going to keep looking at those companies, and there could be some decent entry points to move into those higher quality businesses and potentially even upgrade the quality of the portfolio.
I think that's a key point that you make, is that we're always trying to better the portfolio, be it quality, be it whatever, if dividends are something we're after, or income, or whatever aspect of it is, we're trying to always improve on it. And that's why we're looking at the portfolio kind of all day, every day, really. And I think that also talks to why we, embody or include a number of senior portfolio managers and a big team that are part of the discussion. maybe when it comes to decision making, we narrow it down a little bit because just to make things easier when finally pulling the trigger. But I think we look at the broad expertise across our portfolio management team into that. So while the companies need good management, we need good management of the portfolio as well. And I'm pleased to say that we have that as well.
Certainly, and I think our process, we really work on our investment process. We don't just look at companies, we look at our process. And we've been really working on our process, and we've set ourselves very high standards within that process. And I think it's going to benefit us. It can only benefit us going forward.
Yeah, I think we're on the right path, and onwards and upwards, and we just have to endure this volatility and uncertainty in the short term. But as you say, the quality and the performance will out over the longer term.
For sure. Thanks, Craig.
Thanks, Jonathan.
And thanks for watching. I hope you found this informative and helpful.